The Strait of Hormuz is completely paralyzed. Asian refineries are literally starving. And the Fed's rate cut timeline? Yeah, that just collapsed. What we are witnessing right now is an unprecedented physical shock that is actively triggering a massive global cascade failure. Let's get right into it.
Look, this is not just an energy story, okay? It is a full-on systemic fracture. Following the military strikes on Iranian installations back in late February 2026, the Strait of Hormuz basically became ground zero for a historic supply shock. We're talking normal commercial maritime traffic going from roughly 35 tankers a day, plummeting all the way down to absolute zero. Red warning lights are flashing over major Asian industrial hubs as we speak. Just to put that number into perspective for you, we're looking at 20 million barrels of daily global oil supply, just trapped, stuck right behind a geopolitical wall. That is roughly 20% of the total global supply, and a full third of all seaborne crude. Just to ground us in history for a second, this physical disruption is literally double the magnitude of the 1956 Suez Crisis. It's just a staggering number. Now you might be thinking, hey, can't we just reroute the oil? Well, the math behind the mitigation efforts, or the lack of them, is pretty terrifying. Alternative pipelines like the Saudi East-West and UAE Fujairah lines, combined with massive strategic petroleum reserve releases, they only offset about 7 million barrels per day. So do the math. That leaves us staring down the barrel of an unmitigated structural shortfall of 13 million barrels every single day. The workarounds are completely failing to cover the gap. All right, before we trace exactly how this massive energy shortfall bleeds into the global tech sector and ultimately your portfolio, just a really quick note. This explainer is strictly for informational purposes only and does not constitute financial or investment advice. Always do your own research, folks. Okay, moving into Section 1, the Adversary Entente, a new geopolitical reality. So out on the water, this new reality is basically operating like a giant maritime protection racket. And this maritime paralysis translates instantly into a severe energy access shock, right? Especially for Asia. I mean, they haven't seen an energy squeeze like this in 50 years. Asian refiners usually source up to 80% of their crude from this specific region. So with that flow just totally stopped, polymer prices have spiked, petrochemical plants are literally sitting idle, and Dubai crude, which historically is usually cheaper than Brent, is all of a sudden trading at a massive $20 premium. Supply chains are tightening up, and they're doing it violently. Which brings us to Section 2, the tech blockade. Silicon in the crosshairs. So take a look at this timeline. It really lays out the relentless escalation of Sino-US technology blockades, because as these geopolitical alignments have hardened, so has trade protectionism. Back in May 2026, Chinese customs completely halted the import of NVIDIA's RTX 5090D V2 gaming chips. But honestly, this was just the latest move in a systematic regulatory effort to restrict Western AI silicon. This stretches all the way back to the state data center bans and H200 purchase restrictions of late 2025 and early 2026. Make no mistake, global tech is actively fracturing. Now for Section 3, Stagflation returns, the macroeconomic wall. And that fracturing brings us to a really stark realization. 0%. That is the current market-implied probability of an interest rate cut from the Federal Reserve by December 2026. 0. Major macro models have entirely collapsed the Fed's timeline. All that initial optimism we had back in early 2026, that is totally evaporated. It's been replaced by this harsh reality that central banks are basically trapped by these structural supply shocks. Listen. If you want to actually survive this macroeconomic fracture and stay ahead of the curve, you need to hit that subscribe button right now. Subscribe to Next Gen Invest Global for the absolutely critical, market-saving macro intelligence that you are going to need as this cascade failure continues to unfold. Okay, so let's dive into exactly why the Fed is so trapped here. Some economists will try to tell you that energy spikes just drain consumer spending. But the reality is that supply-side shocks inevitably bleed right into downstream production costs. US PCE inflation is just stuck near 3%. And why is that? Well, think about it. Producing a single car tire takes 7 gallons of crude oil. Seriously, who knew rubber was so thirsty, right? Transporting your basic food requires diesel, so energy shocks always become core inflation shocks. And that is driving up one-year inflation expectations drastically. And here is the actual damage report on equities. The combination of this sticky inflation and geopolitical instability triggered a 4.6% decline in the S&P 500 in Q1 2026. That is its worst quarter since 2022. That multi-year dominance of mega-cap tech we all got so used to, it's cracking. I mean, we've seen a brutal 30% meltdown in the software sector alone. What we have on our hands right now is a market defined by extreme dispersion and really severe valuation distortions. The whole disinflationary boom narrative, yeah, it's completely dead.
Which leads us directly into Section 4, Portfolio Defense Strategy, Navigating Extreme Dispersion.
So here is the crucial point, the actionable roadmap you've been waiting for. First off, you must exploit this extreme market dispersion. We are accumulating gold as a primary hedge against fiscal dominance and currency debasement while remaining firmly bearish on Bitcoin. Second, you are going to want to overweight nearshoring ETFs. Because as global trade fractures, these localized supply chains, they're basically the only safe haven left. And finally, you need to shift your equity exposure heavily toward large-cap quality equities. You want the companies that actually have the pricing power to weather the sticky inflation.
The era of frictionless trade is officially dead, and the macro data is moving faster than ever before. You cannot afford to be trading yesterday's narrative in a fractured market. Do not wait for the next shock to catch you off guard. Binge our previous geopolitical risk models right now on the channel, so you can stay fully ahead of this curve. The intel is right there, waiting for you.